Is Sean Moss with Down Payment Resource. I am the Director of Operations and Customer Support. We also have with us Fern White, who is our account manager, William Medina, who is a DPA program specialist on our down payment assistance program data team, and Veronica Kandawal, who is our Director of HFA Relations. They will be in the background answering questions and reacting to comments as we go. We want to keep this interactive. So ask your questions, share your stories about working with DPAs. If you've got a success story or a cool blog or some recent Down Payment Connect use cases or activity or traffic, we'd love to hear about it. We'd love to share that with our marketing team and maybe connect with you and do something more with that story. So if you will use the Q&A feature from Zoom to pose your questions or comments, then William and Veronica and Fern will be in the background monitoring those. So with that, let's dive in today to Down Payment Programs 101. We want to talk about the basics, what real estate agents need to know in order to confidently bring up and discuss down payment assistance opportunities and solutions with their clients. Our goal at Down Payment Resource is to track and monitor all of the homebuyer programs across the country and help you connect your home buying clients to the down payment help that they need. We do that through a number of tools and partnerships. We'll show you some of that today. But the focus today is to show you how to talk about DPAs, the basics of some of the most common types of homebuyer assistance. A little bit about us. We are a nationwide database and a matching engine of all of the roughly 2,200 homebuyer programs around the country. We partner with MLSs and integrate into MLS and property listing data. We'll show you who those MLS partners are. So if you are a member of one of those MLS partners, you have all kinds of down payment resource tools at your disposal already, free of charge. We do have a subscription service for those of you who are not members of one of those MLS partners. And we have a tool that will help loan officers as well. We'll show you that later. But what we want to focus on today is how to help you become the down payment hero to more buyers and more borrowers. So when we talk about homebuyer assistance, what are we talking about? Loans, grants, tax credits, or other programs for eligible homebuyers that can help them accrue or achieve their down payment faster, can help them cover closing costs, can provide some other short-term and long-term benefits that we're going to discuss in more detail here today, and ultimately help them get into a home sooner than they would have otherwise. Or put another way, to help them stop renewing leases and start accruing the value and the wealth created by home ownership. That's what we're talking about today. And we're going to break down 3 of the most common types of home ownership programs here in a couple minutes. But big picture, what is homebuyer assistance? What is a home ownership program? We probably all hear the terms DAP or DPA. That's one type of homebuyer assistance program. Now, down payment and closing cost assistance does make up the majority by a big margin of the homebuyer programs that are out there. But we also track, as you can see on the right here, affordable first mortgage options. Those typically come from your state housing finance agency or local housing finance agencies and are coupled with down payment assistance programs. We also track and monitor all of the mortgage credit certificates that are out there. Those are tax credits, not like what you're hearing out of DC now. We'll see what comes with a lot of the proposals coming out of DC, but there have for decades been mortgage credit certificates from many states or state housing agencies. So we're going to talk about those today as well. And then there are some other programs that are less common, like matched savings programs, employer-assisted housing programs, housing choice vouchers. They're out there. We're not going to focus on those today because the vast majority of what's utilized and the vast majority of the funding out there for down payment assistance, for homebuyer programs, is for down payment and closing cost assistance, mortgage credit certificates, and affordable first mortgages. Now, within that down payment assistance category, there are really a lot of different types of DPA or down payment assistance. That really is sort of a catch-all term, and we'll break this down more in a few minutes. But within that category, you have grants, and a grant is a true gift at closing. There is no subordinate loan. There's no second lien. There's no lien on the property. A grant is a true gift at closing, and some down payment programs are grants. If not, it's a down payment assistance loan. Now, even loans could be deferred, meaning they don't have monthly payments or the monthly payments don't start immediately. They may be forgivable. So 2/3 of those programs are deferred. 45% of them are forgivable in part or in full. Now that may not always happen, immediately or within the first few years. It could be incremental. It could be at some point in the future. And then 40% of programs are both deferred and forgivable. And then, of course, there's the category of down payment loans that do have a monthly payment where it starts when you close on your house. So even within that down payment assistance category, there's a lot of variation. There are a lot of options, a lot of different kinds of repayment terms and qualifying guidelines. And that's really what we're going to break down today is give you a good primer on down payment assistance and a couple other very common homebuyer assistance program types, and make sure that you're confident and comfortable bringing these up and discussing them and pointing consumers to the right tools and partners and resources to explore these options and, quite frankly, to create buyers that don't know about these programs but could otherwise qualify for a mortgage and for home ownership. Now, just so everyone's clear, our audience today is large and all over the country. These programs exist everywhere. There really isn't a county or a market that's not covered by some kind of down payment assistance. Now, there are obviously more programs in bigger metropolitan areas where there's more people, more real estate, but the state housing finance agency in every state covers the entire state. So no matter where you are, every state has a state housing finance agency. At the very least, their programs are available anywhere in the state, up to, of course, income and purchase price guidelines and so forth. But the point here is, even though on this map you see that a number of states are highlighted because they have the most programs, there are programs in every state, and there is a state housing finance agency in every state whose programs are available in every market within that state. Now, who offers these programs? I've already mentioned some of these entities. State and local housing finance agencies. Every state has one. There are local housing finance agencies as well in many bigger markets. Municipalities like cities and counties, they often get money from HUD or other sources, which they use to fund down payment assistance or closing cost assistance programs. Employers may sometimes offer some sort of down payment assistance to either recruit or to retain talent. There are countless nonprofits across the country that have some form of homebuyer assistance, often coupled with homeownership counseling, homebuyer education, and so forth. And then there are even smaller housing authorities. There are community development financial institutions, or CDFIs. There is the network of federal home loan banks that provide funding to member bank institutions who then offer those down payment assistance programs to their banking clients, your clients, potential home buyers, right? There are community land trusts and more. So there are all kinds of organizations all trying to promote and fund and administer affordability solutions through down payment and closing cost help and other homeownership initiatives. And we track and monitor all of those in down payment resource so that you can simply come to us, figure out what's out there, and point your clients in the right direction, and even figure out who your best, relationships and partners can be in order to do so. So real estate agents, we show you how to find participating lenders and uncover homebuyer education resources, connect with the program providers themselves and so forth. Now, big picture, just to take a step back for a moment before we dig into the three most common types of homebuyer programs, we just want to make sure everybody is aware of the fact that down payment assistance programs did not go away because of COVID or market conditions or market dynamics or anything else, nor are they expected to. In fact, throughout the last 18 months, every state housing finance agency and local HFA, for that matter, has remained open and accepting reservations, supporting their real estate and loan officer partners, and serving their local home buyers. Local programs like those from cities and counties and nonprofits are still widely available, and we're adding more new programs basically weekly. Not a week goes by where we're probably not adding a new program from some market, from some municipality, or some housing agency somewhere in the country. Homebuyer education, as you can imagine, is still being done almost exclusively online, although we expect that will open back up and maybe some of those in-person courses will become available again soon. On top of that, and for loan officers, listen in, housing finance agencies all over the country, the state HFAs in particular, saw record volume last year, and leading into this year are still seeing record volume. And of course, record low interest rates help drive that, but that is purchase business. And just so everybody knows, because we hear all the time, sellers won't accept DPA contracts and so forth. These, from a housing finance agency, those are mortgages with down payment assistance for purchase transactions being done at record volume. It is happening. The right partners in place can help it happen in a standard 30, 45-day market time frame. Sellers are accepting these contracts. We just have to make sure we set expectations and that we prepare buyers to strike when they're prepared. Overall, about 80% of all homebuyer programs are currently funded and available. That number is never 100% at any given time. So just to be clear, some of these programs do have seasonal funding. They're never all funded at the same time. 80% is about a normal number, and it has been for a number of years. So about 80% of all homebuyer programs are funded right now. That number is not depressed. It is no longer impacted by COVID. It was early last year, but we've long since come out of that. So the big picture and the reason we put this in here is so that everybody knows down payment assistance is alive and well. It's not going away. We hear more and more attention on affordability and down payment assistance out of DC. So you can expect that more and more consumers are going to start asking questions about these programs. And we want you to be prepared to answer those questions and address those challenges for them. Now, I'll cover some universal requirements for a lot of these programs, and then we'll dig into three of the most common types of homebuyer assistance. First, I want to address this myth that you need 20% down. We cover this in a lot more detail in other webinars, but let's just all get on the same page. We know, because everybody on this webinar is a real estate agent or a loan officer, most likely, we all know that you don't have to have 20% down to buy a home. But study after study after study continues to come out, even as recently as this week, showing that a staggering volume of prospective and likely otherwise qualified buyers suffer for down payment and think they need 20% down, so they stop looking. They don't enter the pipeline. They sideline themselves, they sit on the bench, they renew their lease, and they watch home ownership slip away. We have to address that myth, and we have to do it aggressively, or we're not even going to reach all of those millions of potential buyers who are income and credit qualified, but don't know that they can do this with 0 down or 3% down, home possible, home ready, or 5% down or 3.5 FHA. Veterans need to know about their 0 down VA options. If you're working in a rural market or ex-urban market, and there are USDA qualified properties in your market, then potential buyers of those need to know about USDA loan options. So we have to combat that. But we also need to recognize that there are some universal requirements for these down payment assistance programs. They are only for owner-occupant purchases. These are not for the purchase of vacation homes or rental properties. These are for people buying the property they're going to live in, their primary residence. There is also a minimum buyer investment, and that can come in a couple of ways. Many of these programs do have a minimum cash investment that the buyer needs to make in order to qualify. That can vary anywhere from $500 to $1,000 or 1% of price. It depends on the program. There's also the investment of your client or the buyer's time in completing a homebuyer education class. We'll break down homebuyer education more in a few minutes, but we believe that's a critical investment on behalf of the buyer into the transaction and into their home ownership experience and long-term success. And then, of course, these are not for cash buyers, right? We're talking about buyers who are getting a mortgage and thus must qualify for a first mortgage. So bearing those universal requirements in mind, we want to break down the 3 most common types of homebuyer assistance. Now, we showed you earlier that about 3/4 of all the programs out there are down payment or closing cost help at closing. But we also want to distinguish that from affordable first mortgages, which typically come from housing finance agencies, and then mortgage credit certificates, which is a tax credit, very different from down payment assistance. Now, before we jump in here, Fern is in the background. Fern, can we launch the poll? How often do you work with first-time home buyers? And let's just gauge our audience here. You'll be able to click your answer on the screen and tell us how often do you work with buyers using down payment assistance? So go ahead and click your answer on the screen here, and let's just gauge our audience and see what the the experience is among our audience with down payment assistance programs and buyers that use them. So we'll give you a couple moments here to click your answer on the screen, and then we'll share the results. Okay, Fern, if we're getting close to critical mass or it's slowing down here, let's go ahead and share the results. Okay. Fern, can you see the results? I'm curious. Oh, here we go. Okay. So let's see. This is interesting. So, wow, that's actually 24% of you frequently use or work with buyers who use down payment assistance. That's actually quite a bit higher than what we normally see. So, a lot of you are savvy with down payment assistance and probably have good partnerships in place with loan officers. And I think most of our audience today is real estate agents. But if you're a loan officer, chime in the chat or the Q&A and let us know, what are your best practices? What do you do to ensure that realtors can find you and trust you and do business with you when it comes to down payment assistance programs? For those of you that sometimes work with buyers using down payment programs, we hope that this helps you maybe cover some of the knowledge gap or learn a few new things that will help you realize the extent of the opportunity, or where to build better partnerships and relationships, or just how to better talk about DPAs. And for those of you that do not or rarely work with buyers who use down payment assistance, I'll beg the question, rhetorical sort of, is that because you're focused on commercial or luxury or land or new construction or whatever the case might be? Or was it just because you had a bad experience in the past with the DPA? Maybe it's been a while, and there's a lot of reasons the transaction can go awry, even when a DPA is involved, that are not the fault of a DPA. So maybe give it another try. Good partnerships in place can overcome that as well. But maybe it was just a lack of confidence or awareness about these kinds of programs. So nonetheless, that helps us understand our audience today. And so having done that, let's dive in here and start with down payment assistance programs. And let's just dig into the most common type of homebuyer assistance, which is down payment or closing cost help. Now, these are obviously the most common type of program by a significant margin. We looked at that earlier. They're often nonprofit or government funded or quasi-government funded. There are some employer funded down payment assistance programs out there. But basically what we're talking about is offering several to potentially tens of thousands of dollars in down payment help, depending on the program and the market and so forth. That can come in many forms. And we covered this earlier in some detail. Let me just break this down a little bit more. A grant is a down payment assistance program that does not have to be repaid. It is a gift at closing. It is a true gift from the down payment assistance provider. If the program is not a grant, then it essentially comes in one of three other forms. It's repayable, meaning it's got an interest rate potentially and a repayment that begins immediately. Or maybe it's deferred. Now, what happens after deferral is one of two things. It could be either repayable or forgivable. But a deferred down payment assistance program postpones repayment until maybe the life of the first loan ends, or a refinance, or payment begins some years down the road, or forgivability starts. And then there's the forgivable part. Some programs, and we saw earlier, about 40% of all down payment assistance programs are forgivable. I'm sorry, 45%. That means that while it is a loan when received at closing, it is forgivable, maybe incrementally. So a common example of that would be you get a down payment assistance program at closing, and it's forgiven at 20% per year over the first 5 years, and then it becomes fully forgiven. The debt is gone, the debt is wiped away, the lien is removed, and it sort of becomes a grant, if you will. Now, there are many different variations of all of these scenarios. We can't get into all of that detail today, but the big point here is down payment assistance programs come in many repayment forms. Some are grants, some have to be repaid, many are deferred, and a lot of them are ultimately somehow forgivable, or in some capacity forgivable. Now, what can these funds be used for? Down payment, closing costs in many cases. Sometimes prepaids or certain prepaid expenses can be covered by the down payment assistance program. Sometimes they can be used in limited cases for repair or rehabilitation of a property. And principal reduction is more like, well, here's a common scenario now. There's an appraisal gap. The appraisal didn't cover the purchase price or appraised below the ultimate contract purchase price. The down payment assistance program typically cannot be used to cover the appraisal gap, but it can be used to cover a bigger portion of the down payment on the purchase price, and then the buyer's own funds that remain could be used to cover the appraisal gap. More commonly, though, that's just money's left over at the closing table, and so they will further reduce the principal of the first mortgage, essentially meaning it's a bigger down payment. But down payment, often closing costs, sometimes prepaids, and in limited cases, repairs. Those are the common uses for down payment assistance programs. Now, the first-time homebuyer rule. One common misperception is that down payment assistance programs are only for first-time homebuyers. That is not true. I want to combat that two ways. One, 41 or more, about 41% of all DPA programs do not have a first-time homebuyer requirement at all. Second, let's be clear about the definition of a first-time homebuyer. That is, now this language can differ by program, but essentially someone who has not had ownership interest in a primary residence in the last 3 years. Now, there may be nuances to that language depending on the program, but let's just say, generally speaking, that's the 3-year rule. If you haven't owned a home in the last 3 years, you're a first-time home buyer. It doesn't matter if you bought a home 10 years ago and sold it 5 years ago. You're a first-time home buyer because that was more than 3 years ago. And there are even exceptions for inheritance, for example. You inherited a property from somebody else, but you're not living in it. That doesn't typically make you it doesn't typically prevent you from qualifying as a first-time home buyer. But keep both of those in mind as you consider down payment assistance options and what one might be eligible for, even despite current or recent or past home ownership. Now, some common terms you may hear, we've discussed a few of these. Grant gets thrown around loosely sometimes. A program is not actually a grant unless it is a true gift forgiven at closing. Otherwise, it is some form of subordinate loan or second lien. We've talked about forgivable programs. Those are programs that waive the debt over time. Deferred payments, we talked about that, prolonging or delaying the payments until some point in the future. The affordability period is typically the period in which you have to remain as an owner occupant in that home to accrue these kinds of benefits like payment deferral or forgivability. You may, in some markets, depending on where you are, have a program that has a shared equity feature where and it's not that common, so we're not going to get into it right now, but basically shared equity is when you are provided with X% of the down payment in down payment assistance. And then as the property appreciates from the price at which you bought it to the price at which you sell it in the future, the down payment provider will share in the equity growth of that property. Not the entire equity, but the equity growth from original purchase price to ultimate sale price. Anyway, we won't get into too much detail about that. It's not that common, but we'll see in the future if that gains traction. All right, now eligibility requirements. Most of these down payment programs have income limits. You may be surprised by how flexible those income limits are in your market. They are always market adjusted. They are typically based on HUD's area median income limits for your market, your county, your city, or some other source of area median income limits. So you can imagine that in Lincoln, Nebraska, the income limits are nowhere near the same as they are in San Francisco, for example. Same thing with sales price or purchase price limits. Many of these programs do enforce purchase price limits beyond which the program is not available because the home is too expensive. But as with income limits, you may be surprised at how flexible those purchase price limits can be. And they are also market adjusted to reflect area medians. Now, before I move on from those two topics, we often see income limits in excess of 100%, 120%, 140% of the area median. That's the area average for your market. We commonly see programs that have income limits up to or in excess of 140% even of area median incomes. 80% of the average in the market is not uncommon for DPAs, nor is 100 or 120. But the point of saying that, without getting into a number soup or alphabet soup here, is these income limits are not only market adjusted to reflect the conditions of your market, but they're also surprisingly flexible in many cases. Same thing with purchase price limits. Yes, some programs have lower purchase price limits. Many have very surprisingly flexible purchase price limits. So these programs are not just for the lowest income buyer or a dog of a property with a hole in the roof. That's not the case. Check the income limits, check the purchase price limits for some of the programs in your area, or better yet, realtors, talk to your loan officer partners that participate in these programs and discuss those income and purchase price limits with them to get a feel for the true breadth of audience you might be able to serve with down payment assistance. Now, other eligibility requirements, property location is a critical factor. Now, what our system does is you plug in a location and we'll tell you all of the programs from the state, the county, the city, the nonprofit, and so forth. But that's all determined on the location. Now, that doesn't have to be a specific address. You could just say, you know what, I know what county or what city I want to buy in, what kind of help is out there. And the location of the property tells us all, okay, what state is that in? Who's the state housing finance agency? Are there other statewide entities that offer programs? Which federal home loan bank jurisdiction covers that? What does the county offer? What does the city offer where that buyer wants to buy? Are there nonprofits that operate in that region that also have programs? And all these layers of opportunities become available. FICO and credit, there are also FICO and credit requirements, as you can imagine. These buyers, as we mentioned earlier, still have to qualify for a first mortgage. So these are not cash buyers. They're qualifying for a first mortgage. Many of those same requirements apply here for the DPA. The minimum FICO, though, in most cases, is probably going to be about 620 to 640. That's going to be the floor on FICO. And then, of course, you have to credit qualify generally for the first mortgage. There may be some small few programs that will go below 620, but that's kind of the lowest we see in terms of down payment assistance programs enforcing a minimum FICO score. We covered homeownership history pretty thoroughly when we talked about the first-time homebuyer requirement. But more broadly, your homeownership history plays an important role in your eligibility for programs, because if you are a first-time homebuyer, most programs are generally available to you, presuming that you otherwise qualify. If you have recently owned a home but do not currently own a home, that may restrict the availability of some programs. If you currently own a home, then there may be fewer options available. But as we said when we defined first-time homebuyer, there are plenty of programs that don't have a first-time homebuyer requirement at all. So just because someone currently or recently owns doesn't mean that they're not eligible for down payment assistance just because of recent or current home ownership. It just means that we need to look at the programs available where they want to buy and figure out what the requirements are. Now, we'll talk a little bit more about the impact of military service, either active or previous, veterans. And we'll also talk about the impact of profession on eligibility for DPAs. But there are commonly, in some markets, hero programs or veteran programs or teacher programs or things like that that are for those employed in specific professions. Now, what are the advantages of a down payment assistance program? The obvious one is a bigger down payment. You're lowering the loan to value. Now, I think some of the perhaps underappreciated benefits are things like, as you put down a bigger down payment and lower the loan to value, you're lowering the monthly payment. So that impacts the debt to income ratios, the qualifying ratios, right? As those go down, more improved or better first mortgage options arise. That can improve mortgage insurance pricing, which then again improves qualifying ratios. All of this lowers monthly payments. All of this, or down payment assistance, also supplements cash to close. So maybe your buyer using one of these programs does not have to ask the seller to cover closing costs, or with their down payment assistance, they can cover certain prepaid expenses and so forth, and they don't need to ask the seller to come out of their pocket. If the seller is going to net more from the offer that you make, that's a great competitive advantage for your buyer. But it also helps the buyer retain some of their liquid savings. And we've seen from a number of studies, including a big one from Chase just a couple years ago, that liquidity, more so than equity, is a huge driver of long-term mortgage payment success. Meaning that if one has more liquid money available to them, even just 2 or 3 months of reserves when they go into a home, they're far more likely to be able to sustain home ownership than if they had less than 2 or 3 months of mortgage payments in savings. So adding a bigger down payment supplements cash to close, but also helps a buyer retain their savings, retain their liquid money available to them in case of emergency. Because as we all know, there's a lot of new costs that you're burdened with when you become a homeowner as opposed to a renter. So making sure that buyers are prepared for that has a significant long-term impact on sustaining home ownership. And then lastly, basically all of this increases the purchasing power, because what we haven't changed here is the borrower or the buyer's income. If keeping that factor the same, their income is what it is when they go to qualify for a house, right? So without changing that, a down payment assistance program can change all these other things, which increase the purchasing power of their income. Now, homebuyer education, we mentioned this earlier. This is a common requirement among down payment assistance programs. It's required. The completion of a generally HUD certified homebuyer education course is often required by a down payment assistance program. There are many online options. In fact, what kept a lot of down payment assistance programs and providers going over the last 18 months was the fact that they either already had online homebuyer education course options, or they quickly adopted one and they were able to keep their program going. We are big proponents of the homebuyer education process and coursework because it not only creates more prepared, better educated buyers, clients for you while they are purchasing and closing on a home, but some of the content of this course also speaks to and addresses the expectations and challenges and some of the pitfalls that a homeowner may experience, which is helping prepare these buyers, your clients, to be more successful long-term home owners, which we think is just as critical as preparing them for the transaction itself. Okay, now that is down payment assistance programs, but we also want to distinguish that and compare that to affordable first mortgages and then mortgage credit certificates. Before we do that, Fern, I think we have another poll. If we can put that up on the screen here. And again, you'll be able to click your answer on the screen and tell us, I forget which one this is. What % of your business is made up of first-time home buyers? So click your answer on the screen, and then we'll take a quick look at the results. And then we're going to dive into affordable first mortgages and MCCs, or tax credits. All right, and Fern, if we're close to critical mass here, let's share the results. Okay, so let's see. More than 3/4 of you are getting about 19-20% of your, no, let's see. Yeah, no, about 20% of you are doing more than 3/4 of your business with first-time home buyers. That's pretty big. And then almost 1/4 of you are doing half or more of your business with first-time home buyers. So that's good. I mean, you would think that, if first-time home buyers make up what, plus or minus 40% of an average market, then we would kind of expect these numbers. For those of you who aren't working a lot with first-time home buyers, again, I'll beg a question, and it's somewhat rhetorical, but food for thought. Is that because you've been in the business a long time and most of your business is repeat or referral? Are you dedicated to some other niche or sector? Or does your marketing not cater to first-time home buyers? Do you want more first-time home buyer business? Are you new to the industry and looking to gather first-time home buyer business? So again, for those of you that are doing, less than 5% or less than 1/4 of your business with first-time home buyers, that's obviously skewed in relation to the ratio of first-time home buyers entering the market. So we would just pose the question, food for thought. Why are you not doing as much business with first-time home buyers? And if that's what brought you here, I hope this helps uncover a path to more first-time home buyer business. So with that, Fern, we can knock that off the screen and let's move into affordable first mortgages. So we covered the most common type of homebuyer assistance, which is down payment help. Now let's talk about affordable first mortgages. So these are programs that most of the time come from your state housing finance agency or a local housing finance agency. That's different from a municipality. But these mortgage options are sometimes only available through a housing finance agency and can offer things like reduced or below market interest rates. They expand the pool of first mortgage options available to a buyer. They can offer reduced mortgage insurance costs, even at higher LTVs. Of course, they can be combined with those same agencies' down payment assistance programs, and sometimes with the tax benefit of a mortgage credit certificate. The advantages being reduced buying costs, better mortgage, better MI mortgage insurance pricing. These are all lower rate, right? These are all ways to reduce the buying costs and thus reduce lower monthly payments. And as a byproduct, as we discussed earlier, with income remaining the same, when the applicant comes in the door, their income is what it is. All of these things compound to increase the purchasing power of that buyer's income. And again, all of this serves to expedite home ownership for them. The problem is we need to make sure that buyers understand they don't need 20% down. They know that low down payment mortgage options are out there, affordable mortgage options, and they know that there's down payment assistance help for those for whom it's relevant or necessary. And all of this can help bring renters out of the lease renewal dialogue and into our home buying pipelines so we can make home buyers out of them. And then lastly, I'll cover mortgage credit certificates. This is very different from down payment assistance. This is a tax credit, and it is one of the most common and most valuable home buyer programs out there. They're not available in every market, but if your state or your maybe local housing finance agency has a mortgage credit certificate, that is a federal income tax credit, not a deduction. So to clarify, we're all familiar with the mortgage interest deduction when we go to file our annual tax return. That is a reduction of your income based on the amount of mortgage interest you paid. What a mortgage credit certificate does is give you a tax credit against your tax bill based on the amount of mortgage you paid, mortgage interest that you paid. And it's good for the life of the loan. It's good every year when you file your taxes, but you have to get your buyer a mortgage credit certificate before they close. You cannot retroactively go back and get a mortgage credit certificate from your state housing finance agency or whomever might provide it. The main benefit here is obviously offsetting the cost of mortgage interest and providing a tax incentive at tax time that is more advantageous than your standard mortgage deduction. This becomes increasingly important as you think about the changes to like the standard deduction in the last couple of years, and the impact that's had on many people's ability to deduct mortgage interest. So having that tax credit would be an additional benefit, and you know, the mortgage interest deduction is always forever on the table in terms of tax policy and changes, but that mortgage credit certificate would outlast those. So and I'll add one last point here at the bottom. You still get to deduct the remaining mortgage interest that you pay after claiming the mortgage credit certificate credit. So basically, it's reducing your income tax liability and potentially increasing your qualifying income, because some mortgage credit certificate issuers or providers will allow a lender, not all of them will do this, but some will allow the lender to take that mortgage credit certificate, that tax credit value, and annualize that across a year and increase their qualifying income, knowing that part of their interest in the housing payment is going to be offset by this credit. And some will allow you to reissue the buyer. Some will allow the buyer to reissue that mortgage credit certificate through a refinance. And that's another big deal too, because it lets you re-up on the MCC for the next mortgage. Now, a brief overview of how this works, and I won't get into any more heady math than this, but let's take a $200,000 home price and a 4% mortgage interest rate. You can tell that's dated, but nonetheless, let's roll with it. So let's say you closed and you closed in January, make 12 payments, and you paid $8,000 in interest that year. Now, a mortgage credit certificate may allow you to take anywhere from 10 to maybe 30% of the mortgage interest as a tax credit. The rest is then deducted as part of the mortgage interest deduction. So in this scenario, you got a $200,000 home and a 4% mortgage interest rate. That's $8,000 interest paid over 12 payments in the first year. Then if, let's say, the mortgage credit certificate allows you to take 25% of that mortgage interest paid as a tax credit, that's $2,000 as a tax credit. The remaining $6,000 of interest you paid, you still get to claim as a mortgage interest deduction. So that's basically how it works. In most cases, the maximum credit you can get is $2,000. That's an IRS limit. And then the rest, of course, is claimed as a mortgage interest deduction. It's a great program. Again, not available in every state, but where they are available, there are awesome opportunities for long-term value, long-term savings, long-term benefit if your client qualifies and if there's one available. So talk to your LOs. Okay, now we covered the 3 most common types of programs, but there are many other unique circumstances and benefits where down payment assistance programs can offer added value or can open new doors for you or your clients. So let me cover a few of those briefly. Targeted areas. These are areas that are targeted for redevelopment or infusion of owner occupancy, reduction of blight, any number of things. And in those targeted areas, some program providers may have no or a waiver of the first-time homebuyer requirement. You may see more down payment assistance money available from the same program if you buy in a targeted area. You may also see higher income limits and purchase price limits for those buying in a targeted area, but they are, of course, limited to specific locations. That can be census tracts, certain zip codes, maybe a whole city or a whole county, but they're often limited geographically to the boundaries of areas that program provider designates as targeted for a number of things, but essentially community development and infusion of owner occupancy. Now, I mentioned targeted professions earlier. I said we'd come back to it. So here we are. There are in many markets what I'll broadly call hero programs, but those are programs that are specifically for educators, first responders, healthcare workers, municipal employees. Now, there isn't one of these in every market, but where they exist, they can offer interesting and additional value adds and benefits for those employed in some of these core service professions. That does not mean that an educator can't qualify for any other DPA. They certainly can. Likewise, a first responder, law enforcement, healthcare workers, and so forth. But where they exist, these hero programs may offer additional options, layers, or just unique benefits to those in these professions. Same for those who have served in the military or actively serve in the military. One common benefit of those programs is a waiver of or just no first-time homebuyer requirement. That's not universal, but it is a common benefit of military or veteran DPA programs. They can often be combined with VA loans for added equity or to cover closing costs. Now, I'll pause here because we get questions about this sometimes. Well, it's a VA loan. You don't need a down payment. You know what? You're right. But how cool would it be to say thank you to a veteran and give them extra equity in the door by using a down payment assistance program? Or just because it's a zero down loan, if they're qualified for that VA loan, doesn't mean there are no closing costs. They still have to figure that out and cover that. Well, what a great value add if you can use a down payment assistance program to help them cover the closing costs and potentially not have to ask the seller to do so and allow them to compete and win that bid. I'll give you an example of one program for veterans. It's the Penn Fed Foundation's Dream Makers Grant. That one is actually a 2-to-1 match up to $5,000 as a grant that they offer to, in this case, first-time homebuyer veterans or active duty, and I think reserve and guard. But essentially, the veteran brings up to $2,500 to the table, and the Penn Fed Foundation will match that 2-to-1 as a grant. So that's another $5,000 grant from the Dreammaker program, plus the veterans $2,500. They go into the program, or they go into their home with, or the purchase at least, with $7,500, $5,000 of which was a grant, and they can cover closing costs or add some down payment to their their purchase and go in with equity and no closing costs, or closing costs covered rather. So that's just one example of many veteran or military programs that are out there. And that's one example of a scenario when it makes sense to use a program with a veteran and offer them value, help cover closing costs, give them the gift of equity going into a home, reduce their monthly payment. I mean, all of these things compound, right? Help them retain their savings and maintain liquidity and be better prepared for home ownership. So it's not just about the down payment, it's also about the downstream impact. All right, now, how can we help you access all of this information? We threw a ton at you today, but I hope that based on our goal here, it gives you confidence and clarity about the basics of down payment assistance. But when you leave here today, we want you to know where to go to continue this dialogue, continue your education, and learn more. Anybody at any time can go to downpaymentresource.com and you can do a search, your client can do a search, you can do a search for your client and figure out what down payment or other home buyer programs are available, where they want to buy, at the time when they want to buy. So we track and monitor the changes to all these programs, new programs as they come up and so forth. So at any point, anybody can go to downpaymentresource.com and find out what's out there. If you are a member of the California Association of Realtors, you can go to finddownpayment.car.org. And if you're not registered for their STEPS event, which is actually later today, we encourage you to go do that. You can go to California Association of Realtors website and look for the STEPS event. And anyhow, you can go to finddownpayment.car.org and you can do a search for programs anywhere in the state of California. And there are almost 400 programs just in California. And you can actually get a little bit more detail about those programs. And then we have some additional pretty cool stuff coming at your logged in CAR member site at downpayment.car.org very soon. Now, I mentioned early on that we partner with MLSs. That means we integrate down payment assistance information into your listing system if you are a member of one of the MLSs on the screen here, and we have more coming soon. So if you are a member of one of these MLSs, you will see on agent and your clients will see on client views on MLS listing, in your MLS listing system, you will see a down payment icon that tells you that property is eligible for some number of programs. You can click that button. It tells you which programs are out there, how many, the details about them, who the lenders are, where to get the Homebuyer Ed class done, contact info for the program provider, and a lot more. So we encourage you to use that. Look for this if you're a member of one of those MLSs. Look for this on your listings. That $ with a check mark, that'll be on agent single line, agent detail view. It'll be in your client portal so your clients can see it. So you and your clients can learn more about the down payment programs that are out there. If you are interested in your MLS becoming a partner, then we'll show you our contact info at the end of this. And that's just one of the many benefits that you would get if your MLS partners up with Down Payment Resource. Now, if you are a member of one of those same MLS partners of ours, you also have Down Payment Connect for free. I won't go into a lot of detail here because we have an entirely separate 1-hour webinar dedicated to best practices with this unique marketing tool, but you get your own lead gen landing page where consumers can come search for down payment assistance. But instead of seeing all the programs and results, because they're not your client yet, it's a lead gen tool that that makes the consumer fill out an inquiry contact form and reach out to you and only you. It's your landing page. And that tells you that they're interested in down payment assistance. They saw that you had information about these programs and they want to talk to you. We have a version for agents and we have a version for loan officers. Loan officers, you can also customize which programs display to borrowers doing that search. And you've got a back office eligibility tool. That's because we know you can only promote those programs that your bank or your lender has authorized you to do so. So you're able to coordinate all that with the loan officer version. If you are a member of our MLS partners, you have this for free. If you are interested in lead generation and expanding your marketing and educating new and wider audiences of first-time and other home buyers, then we encourage you to check out Down Payment Connect at downpaymentresource.com/DPC and use that as a as a marketing tool, as an educational tool, and as a way to expand your lead gen efforts at a fixed price and with creativity. With that tool, you can engage and educate new buyers. You can let them complete a program search, generate leads, tap into new and expanded growth markets, run new and creative digital marketing campaigns, expand the reach of your website, offer more education on your website, get creative on social media, and explore the details of the DPAs in your market so you can ramp up your own knowledge as well. Lastly, just as far as gaining access to information, we encourage you to join the Down Payment Insiders group on Facebook as well. That's free. It's just a forum with 7,000 plus real estate agents and loan officers across the country, sharing stories, insights, best practices, challenges, obstacles, and so forth regarding down payment assistance programs and working with first-time home buyers and a lot of the things that we talked about today. So we encourage you to join, if not to participate, then just to listen into the dialogue. But a lot of cool stuff is shared in that forum, in that group. And it's a great way for, especially a new agent or somebody new to DPAs, to just kind of listen in and learn and absorb lessons and best practices from others around the country. I'll leave you with this today, and then we'll get into Q&A. Renters out there want to leverage low interest rates. They need help understanding the mortgage process, especially need help understanding how to navigate the home buying process in this super competitive, super low inventory market. They will adopt your technology. They will self-educate, but we have to help them overcome down payment misperceptions and get over this idea that they have to have 20% down. A great way to do that is to use something like Down Payment Connect and tell them, hey, there are down payment programs out there. You don't need 20%. Here's another path. The reality for many of them is a lot of renters have been leveraging credit to sustain themselves. Maybe they've been saving money working remotely on the other end of the spectrum. Some might be rebuilding employment history or dealing with income instability over the last year or two, which is going to be a problem when they go qualify for a mortgage, or it's going to be an obstacle. And of course, as I mentioned, they need help navigating this rapidly moving market with surprisingly low inventory. So those are the renter mindsets and renter realities that we're combating. And those are the things that we need to address in our marketing in order to capture the attention of this audience and turn them into buyers. So with that, Fern, if you want to kind of lead us in Q&A here, or Will, Veronica, any trends you're seeing that you want to address in the chat or in the Q&A. And I will leave our contact info up here for anybody that has additional questions. That is info@downpaymentresource.com. So Fern, what's going on in the chat or the Q&A?
And lots of great interaction today in the chat. Lots of great questions. The agents and loan officers are getting information from each other. Lots of networking. So this is great. I just want to remind everyone that the recording will be sent out to everyone who attended today's session. So you should have that by close of business tomorrow or first thing Monday morning. Again, great questions. Sean, there were a couple of questions that came in first thing, and I just wanted to make sure that these specific questions were answered live. These questions come from Maj Mosin. The first question he has is, what are the barriers from the lenders and listing agents from their side utilizing these programs? Are they not preferred options that cause loan closings, unexpected issues that cause the deal to fall out, et cetera? And then he wants to know how to overcome some of those barriers.
So Maj, good question. We have another entire webinar dedicated to a lot of this, but I'll give you the quick answer. A lot of times the barriers for listing agents are lack of education and awareness and familiarity. And so it's on the lender, you and your lender partner, to educate that listing agent about what a DPA means. It does not mean it's a worse borrower or buyer. It does not mean that the transaction is going to be prolonged or delayed. A good loan officer that knows how to do these programs is going to do them on time, just like anything else. And if a particular DPA takes a little bit longer, a good loan officer will know that and set that expectation up front so that it's not a delay. It's just a different process. as far as lenders that don't do DPAs, I mean, the only barrier for a lender is their decision as to whether or not to offer these programs. Now, sometimes that's not controlled by the loan officer. It's controlled by their company, or if they're a broker, the broker partners or wholesale partners they have. So you can go to your state housing finance agency and look at their website, and they will have a list of participating lenders. That's a great place to start, and they may also participate in other local DPAs. As far as the listing agent and kind of some of the issues that they and by extension their sellers may have, I think most of it is just a lack of awareness and education. And we're hearing more and more. I think this is maybe the best way to end the answer for you, Maj, is we're hearing more and more from loan officers that are good at DPA and that know these programs all over the country. They're saying in the last 6 months, they are talking to the listing agent. They have been in conversations with the listing agent more in the last 6 months than ever in their careers to make sure that listing agent and that seller know that a DPA is not going to kill the deal. It's not going to prolong the transaction, and they'll stake their reputation on it if they're good at it and know what they're doing. And I said that would be it, but one more thing. So you had a question about over asking price offers. How do they interact with these programs? I think I kind of addressed that, but you can't use a DPA to cover an appraisal gap. What you can use a DPA for is to cover your down payment and leave the borrower's own funds to cover any appraisal gap. So Maj, I hope that helps. We have a whole webinar where we discuss these kinds of things for an hour. So I can't do much more than that right now, but anyway, hope that helps. Fern, what else?
Yeah, Sean, there was a couple other questions that we see frequently that I just wanted to put out there so that you can answer these questions for everyone. And the first question is, does the use of a DPA delay closing by 30 to 45 days?
No, that would be egregious. So most people are closing in 30 days right now. And again, a good loan officer, it's so critical that you have a loan officer or 2 or 3 that knows a few of the programs in your market very well. They will tell you, and you should ask them, how long does it take you to close these, 1 or 2 most popular DPAs in our market? And they'll tell you, I'll do it in 30, 35 days. I can't speak for every loan officer, but we can speak for the ones that we commonly and frequently interact with or have most recently interacted with, which is daily and weekly, guys. They're doing DPA loans in 30 days, 35 days, unless there's some slightly outlier DPA that requires, a 1-week review period or something, but that would be an outlier.
And
Great.
Sean,
And then,
piggyback onto that in regards to lenders and loan officers that typically do these programs. A lot of questions through the networking, people were asking for lenders who in this recording actually are participating in these programs. And if you did not get a network or an answer in response to you, a good place to start looking for who is constantly using these DPA programs with their customers, or who is very much aware of those programs. Take a look at the local HFA or state HFA agencies that is in your location, and they have approved lenders and top loan officers list typically, and that might be a good place for you to start. Take a look at those.
Absolutely. And they may rank top producers too. Those are if you want a loan officer that knows the programs, does a lot of volume, is good at them, and wants your business, go to the State Housing Finance Agency website, look at their list of lenders, look for a ranked list of top producers, and call those people.
great. Another follow-up question to that, Sean, is do DPAs increase the buyer's interest rate?
There are a lot of ways that DPAs are funded. And one way among many is what's called TBA funding. That's typically going to be with your state or local housing finance agency. And sometimes those DPAs will be funded by an increase in the interest rate, maybe a 1/4 point. It depends on how much down payment assistance they want. So yes, that is one way of funding a DPA. I want to throw this out there though. If that buyer doesn't have sufficient down payment, are they a buyer? And if there's not another or better program available, or if they waited 6 months to buy, what do you think rates are going to be in 6 months? So is that really a detriment if it's getting them into the house? And if they waited, how much worse off would they be? Because we clearly know the price of that home they liked is going to skyrocket in the next 6 months. We also know that rates are probably going to go up. So, and what if they had to wait a year, right, to save up more money? I'm not sure that, in fact, I'll put it the other way. I'm sure that the benefits of that increased rate, offering that down payment and the opportunity to buy now, outweighs the drawbacks of waiting 6 months or a year and trying to save more of a down payment, or you're just going to watch the price of the home and mortgage rates go up as you wait. So yes, that's a common way of funding them. Often that question is asked because people are put off by that mechanism, but I think the benefits far outweigh the drawbacks.
Great. This next question, Sean, is from Kimberly, and she wants to know if there are any DPA programs for first-time buyers who do not have a social security number, but they have an I-10.
There may be a small few. Your best bet is going to be through your state housing finance agency, but there are often going to be I don't want to say pretty strict, but they're going to be citizenship requirements for most of these programs. I don't have a better answer for you, Kimberly, other than talk to your state housing finance agency or a loan officer partner you have that works with them and ask that question. I think that's the best we can offer, is to point you in the right direction, but we don't have the answer.
Great. And then a follow-up to that is, how do Section 8 participants use their vouchers with these programs?
So that's typically done through a local housing authority. I would have, if they're already a voucher participant, if there's a home ownership component to that program, which there often is, then I would have them look into that. And while doing so, get pre-qualified for any potential mortgage and look at other DPA options as well.
Great. I'm just looking through the chat to see what other questions we have. Will or Veronica, if you see anything, feel free to.
I see one from Ian here. Ian, there is actually a DPR class next Thursday. What is that, the 9th? Not the 19th, 24th? Is that right? Stellar is doing a webinar next Thursday, the 24th of June, on down payment resource. One of their trainers, John Lipscomb, is hosting it, and they've been promoting that pretty heavily. Check your Matrix dashboard for that message. It should be there, or on the Stellar website.
Sean, I'm seeing a question in regards to combining programs, and also real quick, it seems I may have broken up when I was speaking in regards to approved lender and top LO lists. Those lists are typically located on your local and state HFA websites. All of them had to become approved lenders, and those are the lenders and loan officers that absolutely are working in the affordable space and are good at what they're doing. And as far as the combination, yes, a lot of programs allow layering, which is combining DPA programs, grant programs, MCCs. You would just have to look at their agency requirements.
Yeah, and just for everybody, if you don't know who your state housing finance agency is, go to Google, type the name of your state, and type housing finance agency, and that should be the first thing that comes up. All right, I'm still seeing a lot of questions come in here. We are a good bit over time. Fern, what do you say we take maybe 3 or 4 more, and then anybody else? I've got our contact info on the screen. For anybody else whose question we didn't get to, we apologize. We had a massive audience today, and we still have most of you. So we're not able to get through all these right now. But Fern, any 1 or 2 or 3 that stick out?
There was, let's see. This one is from Jean, and she wanted to know if these programs could be used to purchase a foreclosure.
Yeah, well, so I guess the best answer is, I'll treat that like an SAT question. What's the most best answer? The most correct. So if it's been foreclosed on and is on the bank's, the foreclosing bank's roster or whatever you want to call it, portfolio, then generally I would think yes. In the past, there have been like neighborhood stabilization programs that were specifically for that. If it's going to be the primary residence of the buyer and you're buying it from the bank and you've got a mortgage, and I would think, yeah, you could use a DPA for that. Now, if you're trying to buy it like out of the short sale process or something like that, that's a different ballgame. That's probably not going to work because if nothing else, you've got such tight timeframes, and financing in those cases is not easy.
Good. And there is another one here. What would typically disqualify someone from receiving a DPA?
Well, I'll separate property from buyer. So for the property, the price is too high. That would typically disqualify them. And for the buyer, I mean, you got to be credit qualified. So you got to have, if there's a minimum FICO, you got to have that, but you got to qualify for a first mortgage too. Let's say their income, and well, let's say they're credit qualified, then you've got income, and we covered property. So if they're credit qualified and the property qualifies, then we look at income. You have to be able to qualify for the mortgage, but you cannot exceed the income limits. And some programs will require that for the DPA, not the mortgage, but for the DPA, they count up the household income, which is the income of anybody over 18 and working in the house. That can sometimes cause a problem qualifying for the DPA, but not the mortgage. Then you look at liabilities. Basically, you got to credit qualify, and your ratios have to be in line. Some of these DPAs will have their own qualifying ratio guidelines. I would say those are the most common disqualifiers. The most common obstacle or hiccup, if you will, is probably the homebuyer education class. There is no reason to wait. Have your buyer do it today, even if they don't plan to buy for 9 months. There's no reason they can't do it today, and that certificate is usually good for a year. So have them get pre-approved and start working on this stuff with a lender, and have them go through that homebuyer education class. They're probably going to have to do it anyway, and it's going to make them a better prepared buyer, and it's going to knock out one requirement for DPA.
Great. Do we have time for one more?
Sure.
Okay, so this one is from Carrie. And the question is, if a wife is on the title of a home, but not on the loan, will she qualify as a first-time home buyer if she no longer lives in the home?
Okay, so that must be about separation or divorce. I
Yes,
think
yes.
in that scenario, you will most of the time find that she is a first-time home buyer when she goes to qualify to buy her own home. That is, it's going to depend on the exact language by program, but there are commonly exceptions for divorce and displaced homemakers. So I believe that's a scenario where she will probably be considered a first-time home buyer when she goes to buy her home.
Great, thank you, Sean. Just looking through chat, I think we've answered everything.
Yeah, I see a few more here. I'll address one more question. Where to go for homebuyer education? So when you go to downpaymentresource.com, or if you get a lead from Down Payment Connect, if you're a subscriber or you're a member of our MLS partners, or if you're using DPR in your MLS, if you're a member of one of our MLS partners, in all of those places, when you're looking at the programs, you can click into the program details. So let me go back in the slides here. When you're looking at the, when you're looking at the program details, once you've clicked on this button, or if you got a lead from Down Payment Connect, one of the first thing we show you when you open up the details of a specific program is who the lenders are and where to go for homebuyer education. So the two things that you need to be most concerned about as real estate agents are, how do I find a lender and how do we get the homebuyer ed done? Those are the first two things we show you when you look at program details in any of our workflows. So whether that's through Down Payment Connect, which you can go to the URL here at the bottom, or if you're a member of one of our MLS partners and you're using Down Payment Resource there, we give you information about the program, including primarily who the lenders are and where to go for that homebuyer ed class. So check those out. And guys, we apologize, but we're coming up on more than 10 minutes over. We still got a lot of people here and a lot of questions. There's no way we can get to all of these. So we'll cut it off here, and I'm going to leave our contact info up on the screen here for a moment. Thank you all for joining. Thanks to the DPR team for helping us in the background. And if you have further questions, reach out to us at info@downpaymentresource.com, and we'll get to your question there. And otherwise, we will send a follow-up recording with the slide deck and some other resources for you as well. So you'll get that tomorrow at the latest. And otherwise, thank you for joining. Hope that was helpful. Have a wonderful day. And we encourage you to use our tools and go out there and talk about DPAs with more buyers. Thank you all.